Today I'm going to be talking about seller financing 101. I'm going to go over all the fundamentals of what is seller financing, how does it work, how have I employed it in my business, how you can employ it in your businesses, what are the advantages, what are the disadvantages, and what do you do with it. So without further ado, let's get into seller finance. Seller finance is an alternative strategy of selling an asset that is unlike any other. It is you becoming the bank and you're financing the buyer who can't qualify with the traditional bank. Most of the time you take an asset and you use the multiple listing service or MLS or Craigslist or Realtor.com, whatever it may be. You put a for sale sign. In this case, we use the MLS. We put up the home for $300,000. And when you sell that asset, most of the time the agent says, it's listed for $300,000. We're looking for an FHA, VA, conventional buyer, cash, no problem. People come in, they have a pre-approval, they're ready to go. What happens if you have a client that says, hey, I love the house, I've got a great down payment, okay? I can't qualify from a bank and I've got a good down payment. I'd love the opportunity to buy the house. What do you do with that lead? They're a great viable individual. Most people don't know how to handle that. So this is where seller financing comes into place. For me, I pay cash for the homes, so there's no existing financing. That's also important. Otherwise, we're gonna be talking about subordination of debt, meaning that you have existing debt that they'd have to take a second position. Nobody likes to do that. And the deals that I'm gonna specifically talking about is the home is owned free and clear. You've got lines of credit or cash or OPM, so there's no encumbrances or liens on the property. So when you list this property, there's no debt on there. So the buyer comes in or an agent says, hey, I have a client, like I said, they have $30,000 down. They love the home. Can we do anything with that? And then you say, yes, we can. I believe we can. So what do? So you underwrite the individual so that you verify they have at least 10% or 15% down. People always ask me, what's the qualifier for seller finance? Well, I love somebody that can prove of income, that they have a strategy to refinance me out in a specific period of time, whether it be 5 years, 3 years, 10 years, whatever it may be. Let's clearly identify what their hindrance is, what's their ability to get regular financing to take me out to recycle those dollars that I'm going to carry back for that buyer. So we need to define a time period. My interest rate is going to be much higher than a bank because I'm providing a service, I'm providing a value for those clients. My interest rates typically start at around 10%, 11, 12, depends on what the deal is, depends on the down payment. Obviously, the larger the down payment, the lower the risk. So someone says, I have 50% down on a $300,000 house and they're going to put up 150 grand, you know your risk is very, very low. Maybe you can finance them at 7 or 8%. So those are certain things you need to think about. But a minimum down payment would be 10 to 20% in my opinion, and that's where I've done well in the past. Also, a differentiating factor, if you're listing on the MLS for 300 and you're going to seller finance, traditionally you don't need to get an appraisal. So they're going to, you don't have to qualify with anything else. These deals can close extremely fast. I always tell people, just like anything else, do your inspection. If there's any repairs, I take care of it, and we close regularly. They're going to be on title. I'm going to be in a first position on a deed of trust in terms of a lien that's going to be serviced just like you would pay your regular mortgage. I set up a servicing company, a third-party servicing provider where they're going to send the payments. They process it, take their servicing fee, and make sure that they're current on their taxes, insurance, and everything else. Then they distribute a payment to me. So they handle all the back-end accounting. So it's a very good passive investment. So this works out really well if you don't want to be a landlord and you just want to sell properties and you just want to get an annuity of income. You're getting a high interest rate. Again, for me, I'm charging, let's say 10%. In this example, you'll see how it works out. For my payments to get to $283,500 on a carryback gets me a payment of $2,487.92. And how do you figure out payments? So someone calls you up on this example. They say, hey, see the house is $300. I have a seller finance candidate. Say, great. If I'm going to be tying up, I need a 5% premium for seller finance. So at a 5% premium, I'm going to get more than retail, or maybe that's even retail, but you're offering a fair price on it here. So I'm going to get a plus benefit by sacrificing my dollars today. If I'm going to be tied up for multiple years, I want to get top of the market, and this is what enables you to do that. If you were to sell a $300,000 house, for example, on the MLS, someone offer you $290,000, you may take it. So think about the $25,000 difference by going seller finance. Big, big difference, especially if you can liquidate and sell the note, which I'll talk about in a few minutes. So again, in this example, you list at $300,000, you tell them I'll seller finance you with 10% down, which would bring a payment of $283,500, which brings in $31,500 by the borrower. We close through a title company. I'm in a first position, so I'm carrying this back. And if you run at 10%, and if you go on amortization-calc.com, that prints out, you type in, here's your carryback, $283,500, 10% interest, and that's going to spit out this exact number of $2487.92. That means that you're paying down principal just a little bit. You'll start to see how much it pays down per month. Most of this is going to be interest in the beginning of these notes, and it's amortizing, meaning it's broken down over a 30-year period. So you can actually have a balloon period or define the time period. So if you say, hey, I need this paid off in 5 years or 10 years, you're going to look on that amortization calc, and it's going to tell you every single month, if you recalled that note due, when it would be due or when they have to refinance. So you can actually see that on the specific note. The title company will draft those notes, or an attorney. You want to underwrite, make sure these people can truly afford those payments. Maybe look and see the reserves, check out their income, send them to a lender to underwrite them to make sure that we're setting somebody up for success, not failure. You don't want to be that company that's taking a big down payment and then you have to foreclose on them. That's the recourse if somebody doesn't make their payment. Unlike a rental payment, you would evict them in a situation where you're playing the bank in a seller finance. The major differentiating factor is you have to foreclose. Remember, you're becoming the bank, you're financing them, so it may take 90 to 100 or 120 days, or it depends. If you're in California, it could take a year on the eviction because every geographic location, jurisdiction is different. So you need to truly understand what's the feasibility. There's a thing called the DOCC-FRANK Act, which was enacted, I believe, in July of 2010, which gives consumer protection to ensure that people aren't predatory lending, that you're following the code of ethics to mitigate recessions and taking advantage of borrowers that can't qualify regularly through a bank. It's also super important. We want to make sure we're following the code of ethics, we're following the law. Are they an owner-occupant? Are they a non-owner-occupant? There's much more leniency for somebody who's taking the home as an investment versus an owner-occupant. So you need to understand the difference, make sure that they're signing the proper affidavits, run it through an attorney to make sure you're doing everything by the law, and make sure that they have a viable strategy to refinance it out. So this is in essence kind of how it works. You're getting a high interest rate, you're defining the time period, you're underwriting them, making sure they can afford those payments. You're getting a good down payment, like I said, 10 to 20%. They can't qualify from a bank, so you're providing a service. You're getting a premium instead of $315. You're getting a passive income for, it could be 10 years, all at a great interest rate. But let's say, again, for this example, you bought this home that you're selling for $300, or in this case $315, for $200,000. You put in $30,000. You're hoping to make a gross return of $70,000 or $85,000 before paying closing costs and an agent. Great return. At 10% interest, not only are you getting your interest on your investment, but you're also getting the interest on that gross profit. So if you're into it at, let's say, $230,000, but they're putting down $31,500, you're really only into that house close to $200,000. So you're actually pulling some money off the table when you go and close that deal. And then you're getting paid a premium. You're getting 10%, don't forget, but part of that money you just created on paper by selling it at your new future value of the property, which makes a lot of sense. So you're getting, your return is probably 12 or 13% because you're getting paid your profitability as well. You also have to look in the taxable consequences. When you sell that, are you paying taxes on that $70,000 or $80,000 gain? Is it deferred? You need to speak to your accountant to determine the feasibility, what's owed upon the disposition, upon the sale of that asset as well. So it's something to look at. Additionally, unlike a lease on the seller finance, the buyer owns the house. So just like if you own your own house right now, you can't call the previous owner and ask them, hey, I'm having a leaky roof or the AC. All the repairs, you know what your return is going to be is because they're responsible on the seller finance side. They own the house. They're no longer a tenant. You need to clearly define that when you're selling to them. Say, listen, do your inspection. I'll do any bins or repairs or buyer's inspection notice, seller response repairs. But ultimately, once you move in that house, you get the keys, when we close escrow, it's in your name. You can't call me and say, hey, I need you to fix a pool or do whatever. They now assume any issues with the property. There shouldn't be any, of course, because if you did a good remodel, you got a good inspection, you fix everything, they move in, you're good. So that's one of the benefits of this is you can easily predict, you know what your payment's going to be. And by the way, this is principal and interest payment here. They're going to need to pay taxes and insurance, which is also known as PITI. PITI. PI stands for principal, I is interest. On this amortization calc, that's what it spits out. You have to inform them that they also need to pay any taxes, insurance, or HOA fees if it's in an HOA. So you have to also understand, hey, if your payment here is $2487, you factor in taxes, insurance, maybe their payment's going to be $3,100. So make sure that they clearly understand they're not just paying this, they need to pay the differential, make sure that still falls and aligns with their affordability. Again, we don't want to set anybody up for failure or foreclose on them. It's just a headache. Obviously, if they misrepresent something or they give you fake documents, there's only so much you can do to mitigate that, but you're assuming at their word and at the underwriting of another banker, maybe your attorney reviews them to make sure everything is on the up and up. And then again, we're following this Dodd-Frank Act to make sure that we're doing everything legally and ethically. And then one of the best things that nobody talks about, which has been instrumental for me, is you've created this note, right? You find the buyer, you get your premium, you sell for $315, so you get an additional price for it, which is wonderful. No appraisal, so we're not worrying about, hey, is this gonna close? You can close quickly, which is great on these deals too, not like a MLS deal, which is 30 or 45 or 60 days. We can close these deals as fast as title can do all the paperwork, create the notes, make sure that they're underwritten. Everything, again, is on the up and up, and all the I's are dotted and the T's are crossed. So once we sell this, I like to call it seasoning. The deal closes, everything's good, the buyer moves in, they make their first payment the first month, they make their next payment, you go 3-4 months down the line, everything's good, you're breathing, you're clipping this payment of, $24.87.92 each month. It's a wonderful, what I like to call an annuity of income. It's like a rental payment, but even better because now I'm not paying taxes and insurance on the rentals, I'm getting my interest, I'm getting a great return, things are good. But now all of a sudden, boom, no one has unlimited money. So if you have unlimited money, you could do this all day long and keep the notes. But all of a sudden a wholesaler calls me, Zach, I've got a new deal. Okay, great, well I just put all this money and I carry back this deal. I'm only getting $24.87.92, but I have a note. That's an asset, not a liability. So I'm in a first position, I have a note, I have a carryback of $283.5, a couple months, now the note payoff is, let's call it $283 because they're paying down principal. But I have people, doctors, attorneys, high net worth individuals that want to be kind of in the real estate game, get a good yield, but they don't want to have a headache of being a landlord or whatnot. So I call up those individuals and said, how would you like to make 10%, which is called the par value? Remember, the interest rate on here is 10%. So I can take the note, I have high net worth individuals that call me, say, listen, they've already paid every single month for the last 5 months, 3 months, 6 months, whatever it may be, a year, you've seasoned it. They're great. They've paid perfectly. Here's their down payment. Here's the asset. Here's the pictures. Here's what it appraises for today. Would you like 10% on your money? Wow, that sounds amazing. What do I need to do? Well, basically, we swap that deed of trust into your name. We transfer it, just like banks have transferred mortgages before. All of a sudden, you get a letter in the mail that says, hey, GMAC is now Citibank, or Citibank is now being serviced by Bank of America. Happens all the time. People buy debt, and it transfers behind the scenes. So whether you're paying your mortgage before to Citibank, now it's going to Bank of America, it's the same thing on the private side, is where you have the ability to now sell the note to a third party. They take over this note, so they all of a sudden at the same value. So you're not selling it for more, you're not even discounting. If you really had to sell it and you found a buyer that says, hey, I'm happy to buy this, you can do what's called discount the note from the principal balance was, let's say, $283 at the time. You say, okay, I'll sell you the note for $280. So you're losing $3,000, but you're getting immediate liquidity. So they're taking over the note, they're paying you off in full, and they become a first position deed of trust. They become the bank even behind the scenes. So the servicing company, instead of paying you now, you've sold the note to a third party, Dr. Jones. The servicing company then pays Dr. Jones the money on that note. So it's a clean, streamlined transition. You have the ability as the bank to discount it. I've never really discounted it because I've seasoned these. I've underwritten the individuals. They're good assets. They're getting a high return. Obviously, with the high interest rate, people have to understand they're going to incur some risk, right? Because these people couldn't qualify from the bank. They don't have great credit, but they have good skin in the game because they just put down $31,500. You've already remodeled the home, and let's say the home appraises at $300,000. The investor's only into it, let's say if you sold it again for $280, well, they still have $20,000 in equity. If they had to foreclose and take back the home, that's their leverage on the property. That's how that works, and that's why these are great notes. You're not selling to somebody a $300,000 house and you're selling to an investor at 10% at $300,000. If they have to take it back, they're going to lose because you're going to have to pay foreclosure fees, attorney's fees, the opportunity cost of the capital while you're waiting to foreclose. And then if they go to resell it, they have to pay commissions, probably clean up the home again, fix damages. Not a good deal. But if it's discounted and they have good what's called loan to value below that principal price, now you're in business. That's a win-win situation. So I love seller finance. So think about the fishing analogy. If you go out fishing, you just put one line out there, hard to catch those big fish. You're waiting for the perfect bite. If we're casting multiple lines, meaning I'm list the house for sale with conventional VA, FHA financing, and I list it for lease and lease purchase and add seller financing, boom, I've got a huge net. I'm going to get a lot of fish. I can look at all the different options, and now I'm still in charge of that deal on the disposition side or the buy and hold side. I can dictate all the factors. I can leverage different offers against each other, which even if you're doing this and you got a great buyer on seller finance or a great buyer conventionally, you got your pick of the litter, and that's the position you want to put yourself in to maximize your returns. So that's why it's super important to understand all the disposition strategies from buy and hold and to just straight up in selling to maximize your return as an investor. You also have to look at your liquidity. Do you want to stay in the game? At 10% is a great return. You can get a loan against the note too, which is a rarity. Most banks, by the way, will probably only lend 50, maybe 60% of the loan value. So another option, instead of just selling it because you have a great performing asset, would be to pledge the note to a bank. Say, hey, I'm going to pledge my note to you. What will you give me in return? So on a deal like this, maybe the bank will loan you $140,000, $150,000. But remember, that's not so bad because now you're only into it for $200,000. You put up $200,000, you put $30,000 into it, you're into it for $230,000, you get their down payment back. So how much do you really have invested? $200,000. If you then pledge this note to the bank at 50 cents on the dollar, $140,000, $150,000, you're only out $50,000, and guess what? You're getting a massive return on your money. So that's leveraging that asset to its fullest potential. Or again, you could do the same thing again, pick up a new asset, sell this to a third party, to a high net worth individual. Now you're flush with cash. You've just made, $230,000, $315,000, gross profit of $85,000, which is massive. You're always getting the highest potential yields on these because you're one of the only games in town that's doing seller financing. Not a lot of people understand this. Not a lot of people do it. They're fearful of it. They don't have the ability to do it. They don't understand the backside on divesting the note or holding it. So what you don't know, you don't know. And what you don't know, you can't leverage and you can't execute properly. So this, again, has been instrumental for me prior to the Dodd-Frank Act. After the Dodd-Frank Act, again, you have to be very particular. You have to follow all the note to its exact language, because otherwise you do have a lot of liability. If you don't follow the code and the law specifically, you could be sued for significant money. So be diligent, make sure you learn or have an individual or an attorney. Obviously, we spoke about this before. Review the deal before you sign any paperwork. You can talk about it on a macro perspective to somebody coming in and say, yep, I'm open to seller finance. This is what I like to achieve. And if you can get that individual to come up with these terms, you confer with your attorney, you speak to a lender, you make sure they're fully underwritten, you get a full file, you make sure they can take you out in a specific time period, then you'll be good to go. So this, in essence, is Seller Finance 101. It's my ammunition on the disposition side that works really well along with my lease purchases. Again, and one other clarification, if someone only has $5,000 or $10,000, they're traditionally not a good candidate for seller finance because after either you're paying another agent some money up front or you have closing costs, you're better off just doing a lease purchase, and you don't have to worry about on a lease purchase the Dodd-Frank. The downside of lease purchases, you still may be responsible for repairs, you're paying taxes, you're paying insurance, you may not get the same premium in terms of them being on title if you're just getting lease, so you have to weigh all options. This really works best when somebody has a significant 10, 20, 30% down payment. A smaller down payment, I would veer more towards a lease purchase until they aggregate or they accumulate enough money for a down payment to become a candidate for a lease purchase. You don't want to start getting somebody on title and then they default with $5,000, because remember, if it takes you 3, 4, or 5 months, you lost all that money in foreclosure, opportunity cost of rent, when you can evict them, take over that asset much faster than going through a seller finance foreclosure versus an eviction. So that's kind of the pros, the cons, the back end, the liquidity structure on seller financing, and I've done millions of dollars of these types of deals, and it's been instrumental for the growth, for the return, for the maximization of profits for my business. So it's super important to understand this. Start playing around, go on amortizationcalc.com, just like you see it here. You can type in, again, you can use these examples based on the 10%, 20% down, see what the payments are, look at your basis on the asset, and just again, it's another asset on the disposition side that you can leverage to maximize your return.